Welcome to this course. This is a money management course for trader. What is money management? I'm not talking about risking 2% or 3% of your capital on a single trade. This is risk management, which is important. I don't advise risking more than 5% of your capital on any single trade. But in this course, I'm not talking about risk management. I'm talking about the growth of your capital. If you have a trading system and your trading system have a positive expectancy, how do you grow your account faster? And we look at one of the very popular Martingale betting strategy. This is used by a lot of gambler and a lot of forex EA is based on Martingale betting. It is very popular and it is still being promoted today. The basic concept is that you double up on every loss until a profit is realized and you make money most of the time, which is why this is a very popular betting strategy. And this is a very popular casino game, which is the roulette. And in this case, if you are just betting on either the black or the red, we have a 50-50 chance. Of course, there's a single zero and double zero. This is a casino house edge. So by betting on the black, you have about a 48% or 47% chance of winning. But in this case, we are just assuming there's only black and red and you'll be 50-50. How does the Martingale betting work in a roulette table? Basically, we are betting $10 on black and it doesn't matter, you can use red. If you win, you make $10. But if you lose, you double up and bet $20 on the second bet. And if the second bet you win, you make back the loss on the first bet, plus you make an additional $10. But if you lost the second bet, you continue to double up and bet $40. And if you win, then you'll make back your previous $30 loss, plus another $10. You can continue doing this until you hit your target. It looks very easy. But let's take a look at how this works. Your first bet, if you bet $10 and you win, that's good. You have made your $10. Then you'll start another cycle. This is called a cycle. And in the next cycle, if you bet and you lost, you will have a $10 loss. On your second bet, you are double up and increase to $20. And if you have a loss, your cumulative loss is now $30. And your third bet, you bet 40. On your fourth bet, you bet 80. And if you win your fourth bet, you'll make back your previous 3 bet of the $70 loss, plus you make an additional $10, which is why this is attractive. And then you'll go back to the original bet and start betting $10 again. So if you have a profit target of $100 a day, all you have to do is to win 10 cycles. But what happened if you lost on the 6th bet? Because on your 6th bet, you are betting $320. And if you lost the 6th bet, your cumulative loss is now $630. And in the casino table, if you typically have a $10 minimum bet, then the table limit will be $500. You hit your table limit. And all you need is 6 losing bet and you hit the table limit. And to think about it, on your 6th bet, by betting $320, you already have a drawdown of $630. And $630 just to win a $10 bet. Do you think it's worth it? Is there a better way to trade? If the Martingale strategy is not good enough, why don't we reverse the strategy? And that is what Reverse Martingale is about. Going back to the scenario, we start with $10 and if we win, we are double up to 20, and if we win, we double up to 40, 80, and by the 6th bet, we are betting $320. And if we win, we will win $630 and we cannot double up again because we have already hit the table limit. And if you can win 6 times in a row, we'll be making $630. And all we use is just $10. But of course, if we lost any bet in between, if we lost on the 4th bet, then we'll be losing our previous win of $70 plus $10 more. And this is also the drawback of a reverse martingale system. Because if we were to keep doubling up, and eventually when we hit a loss, we'll lose back all this win plus an additional $10 of the initial bet. So let's examine martingale and reverse martingale. Martingale basically gives you consistent win. A win on any bet will recover all the loss, but a few losses will incur the big drawdown. You'll lose your capital quick and fast. Reverse martingale, on the other hand, is constantly losing, but a few wins in a row will increase your capital. A loss at the end of every round will erase all your win. But one important thing is you'll never go broke with a reverse martingale system. Because when you're doubling up, you're using the profit to double up. So you will never go broke using this strategy. Let's take a look now at Mr. Rich and Mr. Poor. If you have a trading system that trades one contract for every $10,000, Mr. Rich now has 100,000 trading 10 contracts, and Mr. Poor has only 10,000 and it is trading one contract. The first bet is a win. Mr. Rich has now 110,000, and based on 10,000 per contract, Mr. Rich can now trade 11 contracts. But Mr. Poor has only increased his capital by 1,000 to 11,000 and is still trading one contract. On the second bet, it wins another $1,000. Mr. Rich has now $121,000 and trading 12 contracts, but Mr. Poor has $12,000 and it is still trading one contract. So if you are using $10,000 for one contract, the rich will always outpace the poor because they have more money to start with. Let's help Mr. Poor to speed up his account. Learn reverse martingale, because by using reverse martingale, we are using the profit to increase our contract size. And I will let you on a secret to increase your winning percentage of your trading system. It's a very simple secret. If you are interested in this money management course, enroll now in the course and I'll see you on the inside. Thank you.